Good afternoon and welcome to the March Fireside chat with everyone. Rob's not with us today, but just myself and Chris. And obviously we've got a few happenings in the world at the moment, Chris, coming out of the Middle East.
Yes, Clint. Yeah. So look, I mean, I don't. As you and I have discussed, I don't think a complete surprise it was taking place, given and both sides were fairly open with regard to what their red line was and where they were heading. I think maybe going into the back of last week, I mean, most of the stuff coming out of that region and particularly out of press as well was that there were still ongoing negotiations, and whilst they had faltered in some areas, they sort of progressed in other areas, and there was hopeful for a second round of conversations and meetings. So that was how we ended last week, and then obviously as we traverse into the weekend, U.S. alliance with Israel took it upon themselves to preemptively strike parts of Iran, which then triggered a range of events that we've now seen. Look, I think there's obviously risk involved in how this is traversing, in the sense of we don't really have an end sort of outcome to this, in terms of, I mean, both sides are being pretty cagey as to how this ends or what sort of requirements are for it to ending. And even in the sense of US and Israel, they're not too clear on what sort of path forward they expect or want. So I guess for now, market's flying a little blind with regard to it. But for those that are keeping track or paying attention, most of it's been pretty specific type of, I mean, war fighting in terms of aerial sort of specific. So firing at targets, whether they're gas targets or oil targets or defense targets. And there's been little in the way to date with regard to sort of random bombing of civilian targets and the like. So I guess if it continues to sort of traverse that, then maybe there's a quicker outcome here than we would otherwise expect. But obviously it could get quite messy from here. Likewise, it could be over very quickly. So I think from that perspective, we're waiting and watching, and there's much else we can do. In terms of the market's reaction to it, it's been a little interesting. I think leading into this, our view was, I mean, not one that we'd like to stand behind, but I mean, if you look through the last 12, 18 months, markets have largely been unperturbed by most war politics. So whether it's Russia, Ukraine, Israel, Gaza, I mean, markets, as those things sort of flared up, markets largely took no sort of effect to those, and maybe 24-hour sort of pricing in markets. So that has been largely the case. If you look across equity and bond markets today, not a whole lot has moved in relation to that. So that's consistent with the last 12 to 18 months, I guess, in terms of market liquidity and market being comfortable with those sort of gyrations. Where it has definitely played out is in commodity-based pricing. So obviously oil price shot up pretty aggressively over the last few days. And that's predominantly linked to the fact that Iran is taking out or trying to take out installations across the across the Middle East with regard to oil. And then also because of the Strait of Hormuz, which is now shut, which Iran controls passage through. So there's been obviously a significant shift up in oil prices. Beneficiaries for the portfolios, Clint, anything energy related, so anything in the space of ETFs or particular holdings in energy stocks that performed exceptionally well, as you'd expect. And then obviously there's been a bit of flight to safety with regard to precious metals. So gold and silver have also caught it in, with investors seeking to dampen maybe portfolio exposure to more riskier parts and taking or hiding out, I guess, in some of those more precious metal areas. So that's been a beneficiary to some of the portfolios holdings as well.
Yep, agree. So yeah, that's what we're seeing. The markets have hardly blinked, equity markets, and within the portfolios, we had gold up nicely, silver up nicely, and then oil. Obviously, the media is running around with, they've grabbed onto $1 rise in the oil price equals a 1 cent rise at the Bowser for Australians. Whether or not that's true, that's what they're all running with. So obviously, Trump is discussing a 5 to 7 week campaign, and then depending on, but what I've seen is the same as what you've seen. They don't really know what the end result is. I think they've killed some of the people that they thought might assume positions of power, and so if it continues on, obviously there's that inflation risk through higher oil prices and that sort of stuff.
Yeah, sure.
But apart from the happenings over the weekend, what else are we seeing in the markets? Anything of note?
Not really, Clint. I mean, look, that's taken probably headlines, I guess, in terms of headline graphic stuff. It's sort of deferred attention away from reporting season, the end of reporting season, I guess. And then obviously the software sell off that we saw precede that. So that's quickly found its way out of the headlines. The markets pivot to all things war and war related. So from a sentiment perspective, but obviously predating that, we did see a pretty significant sell off in software as it pertains to AI threats to software, and that there was the market had largely played that via rotation. So where people were selling software stocks, they weren't cashing out. Investors were rotating that into less loved parts of the market or under-owned parts of the market. So from a style perspective, value, I guess, from a region perspective, like Europe, Asia, EM, and then from a sector perspective, probably more defensive sort of quality sectors is where investors sought out sort of a refuge, I guess, as they sort of pivoted away from their overexposure to software. That's probably what predated the war in Iran. I think the other thing to note was there was a bit of ructions in markets around private debt, in particular, more so offshore in the US with regard to Blue Owl and a few other providers. So that's still doing the rounds to a certain degree in terms of concerns around private debt. And some of that is adjacent to software in the sense that if you look at private equity, private debt books, there's been a fairly significant rise in software lending and software equity investing, private debt and private equity. And so if AI is a real threat in the software space, that does have significant implications for private debt and private equity books, which obviously aren't marked to market each day. So as this rolls on, if the threat is real, at some point they'll have to mark those books, and that's where there may be some risk in sort of those private debt and private equity books. But that was sort of the environment leading into this in terms of what was a market grabbing or attention grabbing headlines.
Yep. And talking about reporting season, just looking at a couple of changes that we made throughout the portfolio. One of those changes at the end of January, so start of February, was we removed Metcash and added Woolworths into the portfolio.
Yeah.
We bought that in there at $30.36. Obviously, it's had a pretty good report come out. It's jumped to 36.50, so it's up about 20% since we added it to the portfolio. Any sort of notes about Woolies? That was a pretty good pick by you guys that make that change.
Yeah, it was clean. I mean, look, I wouldn't say we always get timing right. They're notoriously difficult with stock picking. What I would say with Woolies is that, I mean, it's a stock that we've always wanted to own in portfolios, but we could never get there on valuation. We always thought it was a bit richly priced. And we understand that in Australia, where people do seek out defense, there's only a few true defensive names. So it does tend to get overbid through the cycle. But it was one stock that obviously got caught up in the last couple of years with regard to management changes. And the strategy there had gone amiss through that period with regard to those management changes. So the stock actually bottomed out sort of in mid 2025, and it got to, I mean, lower levels than $30, to be honest. And so it started to become attractive to us through that period in terms of just the price, the quality of the stock. We obviously needed to see strategy turning around and at least new management being a steadier pair of hands. We got confident in that early this year around that being the case, and it looked too cheap at around $30. So catalysts there were improvement in strategy, better communication regarding strategy, and then obviously more stable management coming through given the changes we'd seen over the last couple of years. They found their way into the headlines too across a range of topics, and that's also not good with regard to the big oligopoly supermarket majors. And in contrast to that, obviously Metcash was the previous pick in the space. Metcash particularly hard hit by virtue of tobacco sales in particular, where Woolworths business is obviously more diverse than that. So we figured in that sort of grocery space, Woolworths looked too cheap to ignore around the $30 mark, given other factors as well. So I mean, good buying. It reported well, which helped push that share price up pretty aggressively on the day. And so we think there's still probably more upside from here in terms of the strategy. Bit of cost out in that program as well, and the grocery business has returned back to where it should be, or where it was prior to the last 12 to 24 months.
Very good. And the other change was that we made in the Australian Share Direct Call was also a good one. We added Rio in there. We bought that at 152. It's 169 now, so that one's up 11%. So they were the two changes. Any major reasons for Rio's addition?
Yeah, look, I mean, optically not incredibly cheap, because it has gone a bit of a has gone on a bit of a tear the last couple of years. So if you look at the last 2 year share price chart, I mean, you see it was pretty healthy even at 152. What we thought that was more portfolio dynamics. So we thought the portfolio was a bit too light on commodities more broadly, and then also we thought the portfolio was a bit light on ASX 20. So you think about, like, I mean, not that we're index tracking or index hugging, but we thought that space is getting a fair bit of money, and we thought within the ASX 20 peak, we thought Rio had a fair bit of growth ahead of it. And look, it's been reporting well. It's been breaking iron ore record targets with lower costs, which is great to see, not with higher costs. And then the market's obviously, market likes the stock at the moment more so for the fact that it's diversifying or trying to diversify away from iron ore. So copper and silver is what it's also got in its toolkit. And I mean, copper and silver prices have been strong the last 6 to 12 months, and production there has also been quite strong. So that was what sort of led us towards adding it. So like I said, optically it wasn't like screamingly cheap, but there was enough in there in terms of the commodity cycle and our attraction towards copper and silver as well.
Very good. One of the other investments changes that we've made, this is in the international growth, special situations, and adding through the diversified portfolios, is we've looked to add some emerging markets exposure into those. Now, the emerging markets are not Burkina Faso and places like that. We're talking places like Brazil, Hungary, Indonesia, India, Korea, Taiwan, etc. So all well-known countries, lowish risk countries, and companies like TSMC, Taiwan Semiconductors. They're based out of Taiwan. Investments ETFs like Vanguard cannot own TSMC, developed only, and TSMC's sixth largest company in the world. So we thought we'd add a little bit of exposure in here, and a lot of these companies that the exposure we used was Pazina and GQG, and a lot of the exposures underlying there is everything things that everyone's going to have heard of: Samsung, Taiwan, Alibaba, Hankook Tires, AIA Group, etc., etc. And the interesting part I thought, Chris, there was just around the difference in the metrics between those two markets. If I'm comparing, say, Pazina, they've got a PE on their book of 11 times versus Vanguard at 24 times. So significantly cheaper for those large companies in that emerging book. The weighted average market cap in the Pazina book is $245 million. So we're not billion dollars, sorry. So we're not talking small companies. And the yield was the other part that I found quite attractive. Yield in the Pazina book is 4.1%, which is not too much different from the Australian market, and significantly higher than what we can get in, say, the Vanguard International ETF, where it's about 1.5%. So I think the addition of those emerging markets is a pretty good point of difference to the portfolio as it stands, and gives us exposure to a whole different range of investments that everyone's heard of and likely uses from time to time, but we just don't have any exposure to them, really.
Yeah, I agree. I mean, look, the emerging markets, I mean, they've been in the doldrums the last 4 or 5 years I mean, markets have gravitated, or investors have gravitated towards US and tech, which has dominated pretty much all equity wins over the last 4 or 5 years. Emerging markets really got drained through that period. I mean, stocks still performing well, just no investor appetite for them. There's obviously a bit of a backlash towards China as well. They're a large component of emerging markets, but that sort of turned around in the last 12 months. So 2025 was actually the best calendar year for emerging markets for some time. Still a long way behind its long-term historical averages, emerging markets, and still a long way behind its relative value versus US and Europe as well. So EM outlook still looks attractive for me, even with a good 2025. And both of those managers you sort of mentioned are well placed to perform well in that environment. So so the outlook for emerging markets now is positive, and managers well set, as you sort of describe some of those characteristics. They look in very good shape in terms of where they're investing.
Yeah, and we went down the active manager route just because we think that that's probably more of a specialist position rather than via a passive ETF or anything.
yeah, more so about managing risk there, Clint. Like, I mean, even though we're bullish the outlook on EM, I mean, EM can go wrong. I mean, there is some political risk there, and so you want to manage it to sort of, I mean, to be proactive in its assessment of risk, particularly sovereign and country risk. Where with the passive approach, you sort of had to accept that comes with the territory.
Yeah, so they should be good additions to the portfolio. The other change that we've made that affected was more forced upon us across the diversified portfolios and the Australian share income was just a change in manager in the Tyndall share income fund, where there was a change in manager. Might get you to speak to that in a moment, Chris, and we moved that to the IML Equity Income Fund. So that's just in the process of flowing through in all the portfolios at present.
Yep. So Tyndall Fund was, was one of our better picks in the space. Tyndall, for those that have been Aussie equity investing for a long time, is an older house name. It's been around for a long time. The one of the risks that we had flagged a couple of years in the last couple of years would be that their book of fund was predominantly institutional based. There was a good sized retail book, but it wasn't large enough in itself to carry the business. The institutional book was very large and historically been as large as sort of 7 or 8 billion. But over the years, we've seen industry funds liquidating their active managers to buy more passive. And that trend has continued over the last 12, 18 months. And particularly with regard to Aussie equity value managers, where value has been on the nose up until recently, it was pretty easy for industry funds to fire value managers on NAS, and that Tyndall got caught up in a fair bit of that. So that saw them, the back end of last year, make a decision from a business perspective to fold their operations into Yarra. So Yarra is the owner of Tyndall, and it meant that Yarra took the decision on behalf of unit holders to close it down and absorb that into the Yarra Aussie equity business, which is a fairly large business in and of its own right. So we did have a look at the Yarra capability there in terms of them absorbing the fund, a quality Aussie equity house and capability, but we felt that they weren't yet proven in the income space with regard to Aussie equities. And so there was more established players in that Aussie equity income space, and one of them is INL, tried and tested approach in Aussie equity income investing. It is a different approach in terms of the way the income is generated there. So INL does use options to generate additional income versus the Tyndall approach. But yeah, like I said, INL's approach is try to test it in market, additional income provider for their portfolio, value quality bent to the portfolio in terms of INL's house sort of approach. I mean, that's a good replacement, solid replacement in that part of the portfolio.
Yep. So that's basically extent of the changes there. We are working through a couple of changes in the strategic fixed interest as well at the moment. We've just got to get those approved. So we'll cover those at the next fireside chat once they're up and running. But unless you've got anything else, Chris, I think we've pretty much covered everything for the week.
And that's it, Clint.
Yep. All righty.
All right. See you next time.